Crypto Hotep here with another investing video. We are on week 31 of the Family Portfolio and Dividends Tracker. If you're unfamiliar with these videos, please go to my channel, look for week number 1, where I go through the methodology, my thought process, and why I create these videos. Very quickly, in a nutshell, what I've done is I created a short list of well-established companies that my family chose from. They chose the companies that they were most familiar with. They chose the companies that they were that they felt good about. And then I proceeded to create a family portfolio within M1 Finance. M1 Finance gives the ability to create individual pies, and every member of my family has their own particular pie of stocks that they chose. Every week we go through this portfolio and we look at the account balances, the activity, the dividends, how the market's doing, and any important events, and we just document that investment journey. These videos are for my own edification first and foremost, and for my family. Hopefully they view these videos whenever I'm gone, and hopefully they'll learn something and carry this on if they want to. If you like these videos, feel free to like, subscribe, comment. But with that being said, guys, none of this is financial advice, but let's jump right in here with the family portfolio. So before we go to this week, week 31, we go back to week 30 to see where we are at. Week 30, we cracked 1,000. So we're at 1019.57 with a money weighted rate of return year to date of 15.48%. Dividends earned $7.87. This week, we are at 1139.13. So yes, we crossed 1100. Our money weighted rate of return is over 16%, and we earned a little bit of dividends, increased a little bit, $7.90. But as you remember, last week our oldest came across a bigger deposit for her stocks. And as I mentioned in last week's recording, that we were dollar cost averaging that deposit. Now that deposit in total was $350. For our oldest stocks was $350, and we dollar cost averaged $100 last week, and we dollar cost averaged $100 this week. And this is why you see that remaining cash of $150 right here. Okay, but let's go into the activity here. Let's see what we got going on. So as we mentioned, or as I just mentioned, we had that $350 deposit here, and then that $100 buy with our oldest here, and then we did buy $100 worth of her stocks this week as well. As we all know, we have McDonald's, Costco, and Apple right there. We keep it simple for our oldest. And then we did have a deposit today, and we had a couple buys today. So today we had McDonald's, additional McDonald's, Pepsi, Target, Starbucks, Church and Dwight. That went to my portfolio. Celsius, you know who our Celsius fan is, my wife, Nintendo, and then Apple here as well. And if you've seen, we are still making our regular deposits every week, or every 2 weeks, I should say, even though we had that big deposit with our oldest for her stocks. We're still keeping that cruise control mentality in terms of keep putting money in and keep investing. Yes, you had one big deposit, but let's keep that cruise control going of what we've been doing. Okay, so let's go to that portfolio here, and we will see what's going on. So as always, we start bottom to top. And at the bottom, unfortunately, again, is my wife. But if you look at the percentage here and compare it with the percentage for last week's video, my wife is slowly but surely making up some ground here. Why is that? Let's click in here. So as we all know, my wife's stocks currently not in the best of shape. We're down 27% year to date. market gain of negative 15, dividends earned 31 cents. Now, if you've been following the channel, this number was in the 30s last week. What happened? Well, Celsius happened again, and this is what I mentioned before. Celsius was on a very strong decline in terms of price. Since May, price with Celsius has been going down considerably. They were at a key level at $30, and they've been at this key level for about, I want to say, 2 or 3 weeks now. Finally, Celsius has pushed through from this key buying area, and in one day alone, they have increased price of over 14% per share. So currently we have Celsius's price per share at almost $35. This is a crazy increase for any type of stock, but Celsius, this is common. Celsius is a very volatile stock, and this is an example of that volatility. Over 14% in one day, those are crypto numbers. So very good to see here. And as I mentioned before, as we've been going through these portfolio trackers, this is really the only Achilles heel of my wife's portfolio. Pepsi's doing fine and Google's doing fine. Despite the lawsuit that Google had at the beginning of the week, we're still holding Google. I really don't feel any other way about it. Celsius was the one thing that was holding her down. But as I mentioned, we are still buying Celsius. And as you saw in those previous buys, we were still buying Celsius. Why? Because we are dollar cost averaging into Celsius, but at the same time, we're lowering our per share buy or per share price for Celsius. So we're just buying on the way down. And we haven't sold off. We just continue to buy. Another reason is because Celsius's fundamentals haven't changed. They've actually had great earnings. They actually are profitable, and they actually have strategic partnerships. They're just having a rough month with price. So I'm very excited to see where my wife's stocks turn and where it goes now, because we have been at the bottom for some time now, and I think time is due. And let's go to our middle stocks. Our middle stocks they've been hovering around that 8% weighted rate of return. That's not uncommon right here. And as we can see here, very solid worth of stocks here. Nintendo is down, but less than 0.2%, not really worried about. Starbucks down over 2%, still not worried about that. We would still buy Starbucks in a heartbeat. And as always, the behemoth Costco will still Costco at the end of the day, up over 22%. Very good to see here. Our youngest in the double-digit weighted rate of return, per usual, up over 24, almost cracking 25% here. And as you can see, as with the previous, our middle, this Nintendo's down over 1%. Tesla up over 45%, Apple up over 33%, and then Starbucks, again, we got into Starbucks earlier with our youngest at a better price than we did with our middle, and that's the reason for that, that disparity in gain percentage. Let's go to our oldest. Our oldest we're just dollar cost averaging, as I mentioned. So you see this big giant curve up. That's because of those deposits there. And that's the power of compounding and the power of DCAing, dollar cost averaging, into your positions when you do have a large deposit here. So despite having that large deposit, we didn't throw $350 right in the market right at that time. We waited, and we still have $150 that we have to put into the market next week. But I think one of the biggest things is we were disciplined with how we deployed that capital for our oldest stocks. And as you can see, money weighted rate of return over 25%, and all the stocks looking very, very green right now. Okay. And mine, last but not least, we will go to mine here. Year to date, we are looking above 13.5%. Dividends earned $6.71. And again, for maybe the fourth or fifth week in a row now, we are all green on all sectors. Okay. Those growth and meme stocks, of course, they're up over 24%. That is welcomed and that is common. Real estate is up over 23%. Finance up over 19%. Industrials, energy, consumer staples. This is the little engine that could steady at that almost 9% return. And then technology, again, double digits right here as well. We can go into consumer staples because today I did buy a little bit of Church and Dwight here, which increased my percentage to a little bit over 10.6%. We may rebalance. I'm not really sure. As of right now, I feel good with the percentages I do have. We did buy Church and Dwight on a red day, which I always like buying on red days. But other than that, our consumer staples and shopping is nothing but green field ahead here. So not bad at all. And as we can see here, my portfolio is, as we can see year to date, my portfolio has steadily increased, but nothing too drastic. It's just been incremental increases here and again. And that's really what investing is. You know, you may get, as we saw, you may get a big deposit where you throw some money into the market, but more than likely it's going to be those small incremental deposits that you make, that you continuously make, whether the market's up or down, right? And as you can see, our starting value January 1st, 2024 was $131.36. The ending value today is $1139.13. That's a tremendous uptick and a tremendous delta, and the year isn't over yet. So as always, guys, before we hop off here, we're gonna go to a little stock detail on Church and Dwight. We added a little bit of Church and Dwight to the family portfolio today, and we will look at that stock in particular. The tool that I am using is Stock Analysis. Stock Analysis is a free tool. I like their layout, and I like the way that they have the data and the information. It's not cluttered, and I can usually make out everything here. So Church and Dwight, think of Arm & Hammer. Arm & Hammer is probably the main brand for baking soda that they have, or that they are known for, if you will. And if we look at the stock itself in terms of price, with the 1 year, we're looking at 15.67% return, which is fantastic, especially for a dividend stock. 5 year, over 32%, and you don't even want to see the max. The max, we're up over 8,000%. So Church and Dwight, very stable stock, and we'll look into the financials here. As I mentioned, they are a manufacturer and they market household goods, personal care, and specialty products. Some of their brands, Arm & Hammer, Trojan, OxyClean, those type of things. Okay. Financial performance is very strong with this company and very stable. You won't see a lot of dips or some highs and valleys. You won't see a lot of those. The analyst price target for Church and Dwight is a buy, okay, at 106.38. But really quick, some of the financials that I saw is with Church and Dwight's, a couple things I look at is revenue. I like to see sales. I like to see revenue growth. We can see a steadily increase in revenue currently from 2019 to 2023. I typically like to click off the trailing 12 months and just look at the years. So I do like to do that as well. Revenue growth, I do like to see green revenue growth, which Church and Dwight does have. Again, your net income, this is after everything has been paid. I like to see that in the positive, which I can see that is with Church and Dwight. Free cash flow, I'd like to see free cash flow increase. And I also like to see it if it's not going to increase, I want to see at least stabilize, which is fine for me when I'm looking at stocks to add. Let's look at our balance sheet. When we look at cash growth, I do like to see some sort of cash, some positivity in regards to cash or holding cash. So decent cash growth here. They went from negative in 2019 and upwards to about 27% in 2023. I also like to look at retained earnings. So Warren Buffett looks at retained earnings where it's not the retained earnings are not the earnings that are given out into dividends, but the money that's left after that that the company actually retains to then put back into the company for better processes and innovation and those type of things. You always want to see this increase or somewhat stay the same. You don't really want to see a decline in retained earnings. So again, perfect example here from 2019 to 2023, they eclipsed that 6 billion mark for that. Okay. Net debt. From a cash perspective, I always like to see that negative if possible or decreasing for me. Okay. And then going to the cash flow side of the house, again, we already looked at net income, but again, always looking at that. Operating cash flow is also another one. If we can stay in the same median, then I'm okay with that. As long as it's not decreasing too dramatically, then I'm pretty good with that. Net cash flow, I like to see that positive for a company. We see that here. And then dividends, of course. Dividends with Church and Dwight, only 1.13 dividend yield, which is, not the greatest, but payout ratio is below 65%, which is usually my threshold. 65-70% is my threshold. But we do have some decent dividend growth here. So above 4% with dividend growth, I'm not mad at that at all. And, one chart that I do like to see from Stock and Analysis is this chart. 10-year dividend chart. You love to see this line continuously go up and to the right for the dividends. So as always, guys, I hope this video was helpful. If you did find this helpful, feel free to like, subscribe, comment, let me know what you think. And as always, guys, thank you and happy investing.